Welcome back, my fellow freedom builders, and welcome to yet another Stock of the Week video. Today we're going to look at General Electric, and at the end of this video I will be showing you if I am planning to buying or selling this stock. It is a huge stock and it is one of the largest that I have taken into this Stock of the Week video. But as always, I am looking at a lot of different aspects. We're looking at some qualitative fundamentals, basic numbers fundamentals. We're looking at dividend, insiders, price to value, short-term view, and some price charts. And today I am actually going to start at least one of the first topics is going to be the price chart, because that is very interesting. Just for those of you that are not completely certain about General Electric, then it is a huge company and it is very old. It was started in 1892, and that means that it is one of the oldest companies in the United States. They have a lot of different divisions. They have power, renewables, oil and gas, aviation, healthcare, transportation, and energy here down here. And they also have a lot of other stuff going on. I'm not even sure they have their capital part here. They have sold some of it off. I'm not sure why that is not here, but a lot of you know the GE capital. But some of it has been sold off, and they are in a huge process right now of selling a lot of stuff. But I'll get back to that later. But it is a huge company. They have 280, 300,000 employees, so it is not a small fish. But as I said, I will start out just looking at some prices, because I am a technical analyst. I'm also a fundamental analyst, but I do look a lot at the technical part, meaning the price chart. And here we can see General Electric. We can see it on a weekly chart scale here, meaning that every single one of these little candles, as they're called, shows 1 week of price development. And here we can take it down in trading view, and we can see that for a long time it has been quite an okay buy. Actually, it has gone up a lot. But then here in 16, 17, they gave us some sell signals. And now, what is a sell signal? I have two primary indicators here. I have this one, which is something called a comparative relative strength indicator. And that pretty much tells us if the stock is doing better or worse than the underlying market. And in this case, that is the S&P 500. So when we start to dip under these two moving averages here and making lower tops, it actually tells us that right now the stock might be going up a bit more, but we are starting to underperform the market, meaning the S&P 500 is moving quicker upwards than the stock here, and we don't want to own stocks that are underperforming the market. So when I get this signal here, that is a clear sell. And I am also looking at a simple RSI indicator here, telling me that when that is below 50, we are also getting a sell signal. So these two combined starts telling me up here that in 16 and 17 we started to get some very clear sell signals. I'm also having the regression channels in here. I'll get back to that in another video. But as you can see, we broke the channel, we got all the sell signals, so we could have gotten out here around 23, 24, 25, and then we didn't have to sit through these entire 2.5, 3 years of downturn. But it has begun to go up lately. And as you can see, we are actually in what I would call a green zone right now, because we are doing better than the entire market seen over time, and the RSI is in positive trend territory. Further, we have broken out of the regression channel, and what I do like to see here, all of you that have been following my Danish channel for years know that what I do like to see is a break, a retracement, and then a further move up, and that should preferably be a power move, as we say. And this is a power move, what we see here. It is breaking up very hardly here, and what we can see here is that the big players are coming in. Now, how do I know this? That is the big players. Well, when we can form a bottom down here in the end of 18 here, and we can just put some percentages on, and we can move upwards with 100% on the weekly chart over 1 to 2 years in a company like General Electric. That means that some huge amount is starting to pour into this stock. That is not just small potatoes putting money in here. And it did start to do very well. But something happened that I'll get back to in a second, because that is very important for the development over the summer here in 2019. But just to make sure that one of the reasons I picked General Electric today is that this is one of the best technical buy signals I can get in my method. So if we can find some fundamentals that is supporting this setup, then I might be interested in buying. But let's get back to that later. Just to give you a brief little overview of the company, then actually they have all of these divisions that we looked at before, and some of them are actually not doing quite so well. We do have the aviation part down here, and they are sub-manufacturers to Boeing, meaning that since Boeing had their new plane grounded because they had this terrible accident, then they are a bit underwater on the aviation part. They also have the power section here that is doing a bit worse than expected. So that, and they are actually two quite large parts of General Electric. So it is a bit hard on them. Then of course there is the capital part. It is not the greatest part, but they have run into some problems there. And as I showed you on the chart, that is what we can see here. There was a huge drop of almost 30% here over the summer in 2019. And the reason for that is that this guy, his name is Harry Markopolos, he went out. He's what is called a financial forensic or fraud forensic. He's looking at companies to see if there's something wrong, and he knows how to look at that. And he came out saying that General Electric was pretty much about to go bankrupt. They had some huge, he said, fraud. He compared it to Enron, those of you that remember Enron, that went belly up a lot of years ago with a lot of fraud involved. He said that this was a fraud and that they had practically been stealing from some of the pension retirement funds that they have been selling to people for years, meaning that people are actually insuring themselves for when they're getting older, and that insurance should be paying for some as a retirement fund, but also if they get sick and should go to a nursing home and so on and so on. And he said that they had practically taken the money and then just spent it. And when Jack Welch was the CEO of the company back some years ago, there was some whispering, some rumors about that how they could magically perform 50% in earnings per share growth each and every year. And what Harry Markopolos said was, this is why they have been stealing from the funds. However, and it is important to be a bit critical about the sources here, Harry Markopolos was hired by a hedge fund that was short in General Electric. And I'm not sure, because I'm not a financial fraud forensic, but there was a lot of critical voices saying, well, he has been promised, and he said that himself, he has been promised a cut of the profit in the short position in General Electric. That doesn't mean that he's wrong, but it is important to be critical when we're looking at information in the financial space. And what came out here in October was a very big article in Fortune. I think I have it somewhere here, and I will link it to you under the video here. But there is a very big article in on Fortune.com saying how the man who nailed Madoff got GE wrong. So this guy he actually found out that Bernie Madoff was a fraud, but they think that he got the GE case wrong. What the article here says is that General Electric was actually not involved in fraud, but that they're more involved in bad judgment. Meaning that this huge insurance play that they have been outsmarted by people, I guess you could say, because people live longer, so they have to get paid for more years. There's also a thing that when the people live longer, they start to have more illnesses, Alzheimer's, for instance, and that's something they have to pay up big time for. Then there has been a couple of decades now with low interest, and some of the things they had planned to make money on with this insurance play was that they got a lot of money in from these 300,000 to 400,000 people, and that they could make some interest on this money. But since we have been in this low interest environment, they have not really been able to make so much money. So they were down something like $15 billion. I think there was a gap in 2018 that had to be filled there. Yeah, that is what the article say, that is the main reason, but it's not really fraud. All right, now where does that take us? It takes us to a place where we might not be so afraid of that, because that was one of the reasons I really thought that General Electric was going belly up, because technically we saw they were bouncing off of the top of this regression channel and they were heading down. And we'll see in a second that one of the analysts that have been very right over some years about the downturn here in General Electric, he is still predicting the price should be down around $5 or so. But right now, it should not, at least not be because of fraud. Then it could be because of bad management, but let's have a look at the numbers to see what we can see here. General Electric has for several years now been in a process of bringing down debt, because they had a lot of debt up through the 90s and the beginning of the new millennium here. General Electric was a true classical conglomerate. They had businesses all over the world. Well, they still do, but they were all over the place. And in the beginning of the 2000s, we saw that the large investors, the large funds had begun to realize that such big conglomerates with so many different focus points were maybe not the best way to run a business. And since then, because GE likes to please the investors, they have been a process of selling out. In the last 2, 3, 4 years, they have really been selling some of their some of the legs of the business. So they have been taking in a lot of capital. We'll look at that in a second. All right, let's look at some of the basic numbers. We have here in Stockopedia, you remember Stockopedia, there's a link to it below, but we can see here that the quality of the company is only a 53. We would like it to be a 70, and this is one of my first scans. If you haven't seen the Stock of the Week videos before, I can just quickly say that this quality rank is, it is kind of a black box algorithm here, but they take the profitability, cash flow margins, some Petrosky F scores, company risk, and so on, and they compare it to all of the other companies on the stock market, and they are quite in the middle. So it is ranked from 0 to 100, and if you are at 53, you are just about in the middle. However, the momentum is a 99. And normally when we are talking about momentum, we're looking at price. But here in Stockopedia, they're looking at a lot more, because they're looking at, of course, some relative strength and price, but they're also looking at earnings momentum, meaning do they have recommendation upgrades, are there earning upgrades, earning surprises, and so on and so on. And in that field, they are a 99, which is kind of great. They're not quite there yet. I would like a quality of around 70 and a stock rank around 70, But let's have a look at that later, because General Electric might not be a company that I want to buy right now, but they might just slowly be getting into my list of potential candidates. All right. Let's look down here. As usually, we have expected earnings per share growth of the entire company of 10%. We have a PEG ratio of 1.9, which is acceptable. I do like it below 2, or just about there, but 1.9 is great. That means we are not paying huge amount for expected future growth, but that is just 1 year out, and we'll have a look at a graph later here. We can also see that the dividend yield is not extremely high, but still, compared to where the company have been and how much under pressure they have been, it is actually kind of amazing that they are paying a dividend. But let's have a look at that in a second. This is the part of the quality that makes me say that I'm not going to buy General Electric right now. Return on capital 1.1%, return on equity 0.8%, and operating margins around 3%. That is definitely not amazing. We can see the Petrosky score at 7. That is okay. As you can see, they are expecting a drop in revenues, and that is mostly because of the parts of the business they are selling off. We can also see that the EPS have been down, but is expected to improve slightly. And if we look down at the cash flow here, we can see that the operating cash flow is getting better. And the free cash flow is also turning around and is hopefully about to get positive. Now, when we look at the dividends, we'll look at this here. And as you can see, they have been paying almost $1 before, some years ago. But in this process, and I think it is a very wise process they have been in, where they have really cut a lot of costs. And one of the costs they have cut is the dividend payment. And I know for those of you out there that are dividend investors, then cutting dividends is an absolute no-go. And that is one of the reasons why dividend investors are staying away from GE right now. We can see that it has dropped quite a lot, but we can also see that the dividend cover, and that is one of the things I'm looking at when we are looking at dividends, because I do like the dividend cover to be at least 2, meaning that the earnings per share can pay the dividend twice, so that they can pay out dividends, but there's still some money left to invest. And if we are looking here, then they have been way underwater here, and they have actually been in negative territory. But since they have been dropping the dividends so heavily, and they are expecting a rise in earnings, we can see that the dividend cover will actually go up quite a lot. And if you are buying a company in the hope of them rising the dividends, then I think maybe not next year or the year after, but in 3, 4, 5 years, if they can keep a high dividend cover, then I think they will start to put some money back into the investors' money via dividend payments. All right, you can see here that they have been working hard on bringing their debt down. That is great. The cash is also going down, but that is kind of natural when you are paying so much debt. So all in all, they don't have the most amazing interest coverage, meaning how easily they can pay off the interest on their loans, but it is positive, and they are in an okay process, I think. When we look at the Guru focus here, we can see quite of the same. We can see that the financial strength is not amazing, but the profitability rank is good. However, and that is one of the things I'm using Guru Focus for, they have some good signs, some medium warning signs, and some severe warning signs. And some of the severe warning signs we can see here is that the gross margin has declined and the operating margin has declined. That is not something we would really like to see. The Petrosky F score is high, and that is, of course, great. Let's just go back a bit here. Yeah, as you can see, the Altman C score, which is indicating how safe the company is, that is down just around the distress area here. So that is way too low. And you can also see that the return on invested capital is not very much higher than the cost of their the money they're borrowing. So we do like to see this span a bit bigger. So it is not a perfect picture, but it's not as catastrophic that some people would like to paint this picture. All right, let's go a bit further here. Here I'm using a website called Sachs, and they're quite huge in the stock world. They're quite huge in the analysis of, for instance, the surprises and the estimates of a company. We can see here that we have the price of the company and we have earnings per share surprises. So every time there's an estimate, and here we can see there's a surprise, meaning that the earnings per share worth 23% larger than expected. And then there's 4 and there is 0 and so on. Then the company it started to drop here in price, and we can see that we had some very terrible negative earnings surprises, and then we started a bit positive again, negative, and right now we've had 3 positive earnings surprises in a row here in 2019. So that is probably one of the reasons why the stock has begun to move upwards. We can also see here, and that is quite interesting, I think, they are collecting all of the larger broker recommendation, all the analysis. What are they saying? And let's just see if we can get it up here. This is on a scale from a 1 to 5, where 1 is a strong buy and 5 is a strong sell. And you can see out here we have a score, that is the average score from the different broker recommendations. And you can see here that it started to drop in 16 and 17, and then the price started to drop afterwards. So that was quite a good prediction here. Then we started to move upwards, and this actually looked very well. But then here in the summer 2019, as I mentioned, we had this possible fraud case, and that made the recommendation drop again. Right now it is moving a bit higher, and what I would like to see over the next quarter is that the recommendation kept moving up, and that would be a positive in my book. If we are looking at the short term here, as you might remember, we are using tip ranks, and they are actually scoring a 10. And that is a bit in the shorter term here. But what you can see is that we have the analysis rating, and that is a moderate buy. If we are looking at that, we can see that they are spread widely between $5 when we're looking 1 year out, and $13, meaning an upside of around 20-25% and a downside of about -50. I am primarily looking at 4 and 5 stars analysis, meaning they have a good historic hit rate. This one, Stephen Tusa, is the one I was talking about from JP Morgan. He's actually the one that has been calling the drop in price for some years now. And he is saying it is a hard sell and the price target is $5. That's 15 days ago. He might be right, but we can see a bunch of the other also quite high rated analysis. They are saying somewhere between 11 and 13. That is not the biggest margin of safety, I would say. If it should hit 12 or 13, and we are right now at 10.5 approximately, that is not that's not amazing. If we look at the blogger opinions, that is bullish. The hedge fund has begun to put a bit more money into it. We haven't anything on the big insiders here. The news sentiment is bullish. The funny thing here is that when we look at the articles, then we can see, we can see that the Boeing 737 MAX, that is the problem child of Boeing, they might have a new problem. That is something that could bring the aviation part here of GE a bit down. But as you can see down here, I found an article. All right, maybe it has dropped a bit down. But basically what it says was that the price of GE is going up and nobody really knows why. Meaning that the price we can see here there's not some big news that is saying big orders or big sell-off of at a very good price or something like that. So several financial analysts were wondering if there was some good news on the way that hadn't really gone into public space yet. We don't know that, but it is interesting that we can see such a big rise in price here without really having any significant news, at least here just in the latest weeks here. So that is that's something we should look out for. I have seen time and time again when I'm using technical analysis, I have seen over and over again that the price is going up and then some news are coming out. And in the financial world, as well as in all other areas of life, I'm pretty much sure that if you want to keep something a secret, it could be some positive news in a company. If you have more than 2 people knowing this secret, this positive news that is still a secret, then everybody knows. Then the news is starting to slip out. I might be a bit conspiracy minded here, but I am pretty sure that if there are very good news coming out in a big company, then it is impossible to keep a secret. All right. Some of the last things I normally do, as you might know, is that I look at fast graphs. And here we can see since year 2000, we can see how the adjusted earnings have moved up here. We can see the green zone here, the light green zone is the dividend. We can just remove that just so we're not confused there. But as you can see, GE has had a tendency of oscillating quite closely around the adjusted earnings and around this normalized PE ratio of around 19. So where are we right now? Well, first of all, we can see that over the last, well, since 12-13, there have been a huge drop in adjusted earnings. And I don't personally like to buy companies that have had this kind of drops. I know that when I get into a stock, I might not, or I actually never get in on the bottom, meaning that I'm not a bottom fisher. I'm not someone that is trying to pick the exact right place to get into a stock. In my world, it is kind of a fairy tale, and people saying, yeah, well, we picked it here in 09 and we went out here. Well, people never get out exactly at the top, and they're never getting in exactly at the bottom. If they do, it is complete luck. It's not something you can calculate into your investment plans. But if we're looking at, now this is over a load of years, but let's look at a shorter time span. What we can see here is that it has been down, the adjusted earnings has been dropping, and now the estimates is that it will be going up. However, I am not very much into investing on, or at least not only on estimates, because what I do want to see, let's just have a look a bit further back. Here, what I do want to see is I want to see the adjusted earnings have been going up for a year or two, and then I want to buy a stock that is trading below where it should be trading and it has begun a good solid uptrend. And that means that I might be coming in here and I might be taking the stock out around here, only quote unquote making 8.5% per year, all included. But I also always, or almost always, sit out. I miss these big drops in price. So I am a classical trend follower, kind of, where I am getting in far away from the bottom and I'm getting in far away from the top, but I'm making a good living on that middle part of the trend. So where are we right now? Well, if we're looking again at the 10 years here, let's just have a look. Then we are above the place where we were supposed to be. We should have gone in, it should have dropped a bit further down and we should have gone in here somewhere. But right now we have an estimate that the earnings will start to grow. But right now I'm not confident enough to buy it. If you're looking at the 5 years here, you can see it a bit closer. Yes, we do have some expected rise in earnings. Here we have 11 and 26%, which is great. But let's just have a look at the forecasting mode here. And we can see that if we should down to the area here where the estimated earnings suggest we should get at some point, then even though it will be rising with 11 and 26%, if we should hit that one in 2 years, we will only be making 3.8%. And if the estimates are not accurate, if they are actually worse than expected, then we could easily drop down in negative zone here. And I don't like that. I would have liked it a lot better if the price had been down here, we had started an uptrend, and we could get a bigger move up in potential earnings rise here. So we can try and put some other numbers in costume here. And we could say, now what if they were not making 11 and 26%? What if they were only making 10%? Then we can see in 2 years' time here, well, we might be making 5%. What if they are making 15%? If they adjust the expectation upwards? Well, then in a couple of years here, we might have made 13% per year, which is great. And if we can actually come up and make 25% in rise in adjusted earnings, well, then we can see that we can make a huge amount of money. But I'm not really confident in that. And looking at the historical graph here, I think the price can go up a bit, but I also think that it will drop down into this zone somewhere, and I will personally wait maybe a year, maybe 2 years before buying General Electric. At that point, I will have seen that maybe these estimated rises in earnings, I might see that they are actualized, that they are actually happening. And if I can see that, the earnings are going up, and I can see that the price is dropping down into cheap territory and starting to trend up on the weekly chart here, then I am definitely considering buying General Electric. It is a rock solid company, meaning that they have been around forever. They are, if this story from last summer is incorrect, then they are probably not about to go bankrupt. But as I said, I would like to see a bit more solidity. I want to see some more actualized earnings rises, and when I see that, then it might be a year from now, and we might be here in 2021, and we can see that we might have had a drop in price and that the trend has started to turn up. So it might be in 14 or 15 or 16 that I get in, but then the price might go to 100. I don't know. I am a trend follower, and as long as the price keeps going up, I am interested in owning the stock. But I do want solid stocks, and I do want to get into the stock when it's not completely overvalued. And right now, with the history of the stock and with the development, I think we are seeing some good signs. I just don't think this is the right stock for my portfolio right now. And as you might remember, I have told you in several videos that this might be an okay buy, but it reminds me of this 5-chair challenge that we see in different talent shows, where I am having a portfolio right now, and to get GE into the portfolio, I would have to take out another from the portfolio. And right now, I don't see General Electric being a stock that can remove some of my other stocks in the portfolio, to be honest. So General Electric right now, the verdict from me, from my strategy, my method, is it is a no-go. It is not a buy. If I did own the stock right now, I think I might hold it, because the trend might be going up, and I'm not sure I would sell it right now. But right now, not having it in my portfolio, I would personally not buy it. Just remember, I'm not a financial advisor, so you should never take my advice here. You should apply your own strategy, your own method, your own analysis. But I hope this can be of some sort of inspiration as to how to analyze stocks, and maybe some input into your own analysis process. I won't take any more of your time right now, so thanks for now. Take care of your money out there, and I will talk to you again soon. Bye.